Yes,
fine. Right. Eid Mubarak to everybody who is celebrating the festival today, and for others, welcome back to the class. So this is our fourth session on this business accounting, and as you know, like we have already covered the accounting process, where we talked about the double entry principles and how the accounting process is carried forward. We have also looked at the framework. So now what we are going to look at is the concept. We will continue the concepts. I just want to find out whether, yes, can you all see the presentation?
no, sir.
No, sir.
No.
Hold on. Is it visible now?
No, sir.
Still not.
How about now?
Okay.
Yes, sir.
Right. Others are also okay with it, right?
Yes, sir.
Yes, sir.
Okay, fine. So
Yes.
let's continue from where we left. I think we stopped at money measurement concept, right? We looked at those two. Am I correct?
Yes, sir.
Right. So we are going to look at the third concept today, which is actually, I think I explained this also. But anyway, let's start with going concern concept. So going concern concept is nothing but states where a business will continue to carry on its activities for an indefinite period. Please note or underline, if you are having a handout, physical handout, indefinite period of time, which is very important. That is the important part of this definition. So we assume, or we we assume that the business is going on and it is not going to stop, okay, unless where the business identifies a specific reason for it to close. So when we say like the business is going to close down, like say we foresee that the business is having difficulties in terms of cash. They are finding it very difficult to manage their liabilities, right? So you know what is liabilities. What is a liability? What is a liability? What is a liability? If it's a physical class, I would have picked somebody to answer this. So since it is virtual, you all have to voluntarily answer. Somebody has to voluntarily answer. Yes. What is a liability? Liability is actually a current obligation. Liability is a current obligation of the organization where they have to meet certain payments, right? So I am not asking the theoretical definition. Theoretical definition is where it also captures the result of past events where you have a obligation to comply with. So in order to meet this obligation, you need adequate assets. You need adequate assets. Now, what are these assets? It cannot be long-term assets. Like you can't sell your fixed assets to settle a liability. Now, say for example, you have your electricity bill to be settled. You have your electricity bill to be settled. Now, the electricity bill cannot be paid by selling one of your computers. That is not practical. So, what do you mean by here? We need to have some liquid assets. Liquid assets. What are liquid assets? Anyone know what is liquid asset is?
Like cash.
Cash. Yes, very good. Liquid asset means it's purely cash, but there is a underlying theoretical definition is there where liquid asset is all assets that can be quickly converted into cash without any loss in capital or interest. Okay, that is the theoretical definition. But in simple terms, as one of you said, cash. If a company doesn't have cash, that is going to be a struggle for them, right? So meeting your liability is one of the utmost important things in your business, where you have to meet in your day-to-day business so much of liabilities. So where we monitor a business is doing well is where the business is capable of meeting its liabilities. Now here comes a situation where a business is unable to carry on its activities because there is an issue, right? There is an issue. So as a result, the company may foresee that it cannot run for the long term or it cannot run in the long run. So they might make a decision, okay, we will somehow survive this year, but next year, somewhere in the middle, we might have to close down this business. Now, when you have an intention to close down the business, that gets into a separate process where winding up of a business, we call it as a winding up of a business or liquidation of a business. We call it as a liquidation of a business. So that is where like a lot of legal procedures come into the picture and you have to follow by that. So then the need to do financial reporting is also will not arise. Why? The owners of the company will not be very interested to look at the company because they know that the company is going to close down. But if you are a company adopting the going concern concept, then you have to be mindful that you are assuming that your business will continue for an indefinite period of time, which means there is no end to this company. It is going to continue. Today, some people will be there. After 10 years, another set of people will come. Another set of people will come thereafter. So this company is going to continue. Now, you would have heard there are a lot of companies in Sri Lanka where they have a history of over 100 years. A history of over 100 years. So, which means this company has evolved from time to time. But still, we have companies which have not really reached that level. But the expectation of a company is to run for an indefinite period. Why we need to do that is then only you can prepare your financial statements to evaluate performance. So it is very important that the going concern concept is a fundamental. For any business, it has to follow the going concern concept. Okay, so if you simply state that, it means every business entity has a continuity of life. Okay, but whereas people, they have a continuity of life, but they will know it ends somewhere. But companies assume that it has a continuity of life without any break. Okay? Then you get the significance. What does it say? It facilitates preparation of financial statements, as I told you. On the basis of this concept, depreciation is charged on the fixed asset. So this is a area where we will look at very deeply later on. What do they say? Now, suppose you are using a vehicle or a mobile phone, let's say. Now, when you keep on using the vehicle or the mobile phone, there is certain amount of wear and tear, right? You are making certain amount of damage to the vehicle or the instrument by using it over and over again, right? It cannot be look like the same that you brought on the day you brought it. Okay, so the day you bought it, maybe it would have been very new, but as you go on using it, there is a depletion of that particular asset. Now, in accounting terms, you need to account for this particular scenario that we call as depreciation. So we will learn it separately as a topic, but for the time being, you need to understand the concept of depreciation is used in businesses because it is linked to the going concern concept. Now, if a business is going to close down, there is no point in depreciating assets because you know tomorrow the business is going to be closed down. So why should I keep these assets? I will sell it off. So here the assumption is you are not going to sell off the fixed assets. You are going to keep on using as long as the business is on, but you will keep on replacing them. You will keep on replacing them. So basically the depreciation is, in other words, the replacement cost. The replacement cost. Then thirdly, it says it is of great help to the investors because it assures them that they will continue to get income on their investments. So this I told you. If you are a shareholder, why you would like to make an investment? Because you want a return. You want a definite return. Otherwise, you will not invest in that company. Now, what makes you to think that you are going to get a return? It is because of this going concern concept. Why? As long as the company is going to continue or survive, you are going to get something. Okay? The amount may differ, but there is a return to you from this investment. Then we also go on to say that a business is judged for its capacity to earn profits in future. So people, how will people look at companies or businesses? They will look at companies when they earn profits. They realize when the company is running on a going concern concept, we can judge the capacity of the company to earn profits in the future. It's only judgmental. You can't certainly say that this company is going to make 5 billion profit next year. No, you can't say that. But looking at what the company is doing today and with the motive of going concern concept, you can say, look, this company will do better in future. This company will do better in future. Okay? That is all about going concern concept. Then we get on to a most important concept, which is known as the accounting period. The accounting period. What does it say? All transactions are recorded in the books of accounts on the assumption that profits on these transactions are to be ascertained for a specified period. It requires that a balance sheet and a profit or loss account should be prepared at regular intervals. Now, this is very important. This is a very important concept. All right. So, Can you all see the board?
Yes, sir.
The board is visible, right?
Yes, sir.
Right. So now we are talking about a concept which is known as the accounting period. Accounting period. Right? So now basically we know that we have financial statements. We have financial statements like the P&L. I will go with the terms P&L and the balance sheet for the time being. Later on we will change these terms, right? So I'll go with these terms P&L and the balance sheet. So you know P&L will have the income and the expense. And the balance sheet will have assets and the liabilities plus equity. Right. Now, when a business concern is on going concern concept, we know that business is going to earn or make a profit, or it could be a loss. So how do we show that? When it is a profit, we show it as a positive number. When it is a loss, we show it as a negative number within brackets. This you have to remember. So in accounting, when you show a number just as it is considered to be a positive number. But when it is shown within brackets, it is known as a negative number. So we don't write, say for example, if it is 500, negative 500, we don't write it like this. Minus 500, we don't write. It has to be like this. So this means it's a negative. Otherwise, it's a positive number. So what does it mean? Just give me a second. Just give me 2 minutes. There is a technical issue. I'll just sort it out and we will. Okay. Right. Sorry. Sorry for that interruption. Right. So, as I told you, when it is a going concern, the business, we are looking at an outcome in it is profitability. So it could be a profit or it could be a loss. But there should be a limit for you to ascertain this profit or loss. Right? There has to be a time period for which we say that it is to be ascertained. Ascertain means you have to recognize. So you have to recognize the income and expense for a certain period of time for you to determine this profit or loss. Otherwise, what will happen? You will keep on accumulating your income and expense where you will not talk about the profitability. Right? So, when you talk about ascertaining profit or loss for a certain period only, this concept of accounting period comes. The concept of accounting period comes. Now, what do you mean by accounting period? Generally, we talk about a 12-month period. 12-month period. So, what do you mean by this 12-month period? It is actually a year. We are talking about a year. Now, when it comes to accounting, we call it as a financial year. Right? So, these terms are not there in the handout. So, when you are listening to me, while you are listening, you have to also take down your own notes, right? So, I'm not going to dictate over and over again. So, while listening to me, you have to take down notes, right? So, you have to understand and cooperate with me because this is not a virtual, not a physical classroom where I can see everybody so that I know what is happening. But here it is virtual, so you have to do your part also, right? Okay, so the 12-month period that you are going to consider to understand or ascertain or recognize your P&L, profit or loss, you consider a 12-month period, which is generally known as a year. Now, this year is actually, for accounting purposes, we call it as a financial year. We call it as a financial year. Financial year. Now, every company will have its own financial year. There is no dependency with one company with another. Okay? There is no general norms also. Anybody can have any type of financial years. But we need to know what is the general understanding of financial years, right? So that is what I am trying to establish here. So under the concept of accounting period, now we have come to understand the financial year. Financial year. Now when you say financial year, we can have several types of financial years. I'm just taking some example. First one. Let's talk about the calendar year. Now you know from January to December there are 12 months and that is a 12-month period which is a year. So you know that it is a financial year. It can be called as a financial year. So in other words, I would say from I'll just take an example, 2021, 1/1/21 to 31/12/2021 would be a financial year. Okay? Why? There are 12 months covered and 365 days or 66 depending on the year. The second type of, or in other words, another common type of financial year is where we start from 1st of April 2021 to when? Can somebody tell me?
31st March 2022.
Very good. 31st March 2022. Look, what is happening here? Now we are talking about a financial year. Financial year, we generally know that is 12 months. So if you are to cover 12 months, what can happen? You have to start with this year, which is 1st of April 2021. That is where you start after 3 months of this year. So you don't have 3 months of the current financial year. Then what will happen? It will go on till December, whereby you will have 9 months. So definitely, in order to cover the 12-month period, you need to go additional 3 months from the next year, calendar year. So this becomes another type of financial year, which is very common, right, in Sri Lanka. Okay? Now, generally, the banks are sticking to this 1st of January to 31st December. But most of the trading companies are looking at this. Okay? Now, there are reasons for that. Generally, people will prefer this, the second option. Does anyone have an idea why it is? Why
It is
could be?
also the tax period.
Pardon?
It is also the tax period.
Very good, very good. Now, in the Sri Lankan context, there is something called a tax year. We call it as a tax year. Now, this we are talking about a financial year, but for tax purposes, we have something called tax year. Now, the tax year in Sri Lanka runs from 1st of April of any calendar year to 31st March of the subsequent year. Okay? So, the tax year runs from 1st of April to 31st March. Right? But this is not actually an issue for these companies who are running the calendar year. Right? Because their performance will be evaluated for this year and they will pay the tax according to this. There is no issue. But generally, when you have the tax year and the financial year, it will be very easy for you to monitor. It will be very easy for you to monitor. Okay? So this is not a must. I mean, having 1st of April to 31st March is not a must. You can have it or may not have it. Right. Then, there could be another type also. There could be another type. That is, where we start from this 1/7/2021. Where will it end? Where will it end?
31st June 2022.
Okay. Actually, it has to be 30th June 2022. Now, this is again 12 months. This is again 12 months, right? But generally, Sri Lankan companies don't use this. But just do some Google and you will see most of the Australian companies are like this. They go on this basis, 1st of July to 30th June. 30th June. They go on that calendar, right? Then the last one, 1st of October 2021 to 30th September 2022. That is also another possibility. That is 1st of October to 30th September. That is also a possible. But apart from this, you can have any type of financial year. There is no hard and fast rule. But for simplicity only, we try to fit into one of these. We try to fit onto one of these. Okay. So basically, you need to know financial years are like this. Financial years are like this. Now, what is the take home for us is, for your examination purposes or from your business perspective, you might get financial statements for you to evaluate. So the financial statements, when you get, first thing you have to see whether it covers a financial year. Right? That is the first thing that you should look at when a customer brings in financial statements for evaluation. Like say when you are trying to give a loan or anything. First thing is you look at the financial year. Then you try to understand whether it is January to December or this or this or this. Right? So for your examination purposes, mostly the questions will be either this or this. Right? So far I haven't seen this being tested. So because that is important. When you are looking at a question in your exam paper, you need to understand what is the financial year that they are talking about. Is it something to do with January to December or April to March? That idea has to be there for you to do the questions. Okay, right. Just take down this. If you have any questions, please ask. Okay, right. So we'll get on to the presentation. Right. So we have looked at the accounting period concept, where it says all transactions are recorded in the books of accounts on the assumption that profits on these accounts are to be accounted or ascertained for a specific period, which is the 12-month period, right? Then it also says that a balance sheet and a balance sheet, let's look at the balance sheet, should be prepared at regular intervals. Now we talked about the P&L, where it requires you to consider a specific period. But when it comes to the balance sheet is not prepared for a financial year. Okay, we will learn this again in LKS 1, where we have to learn an accounting standard. But I'm just giving you now, the balance sheet is prepared as of a particular date. As of a particular date, actually. As of this date. So, what is this as of this date? You pick it from your financial year only, right? So, what do you pick from your financial year? You pick the last date of your financial year. You pick the last date of your financial year. So in this case, if you look at the 4 examples that I told you, so the first instance, the balance sheet will be prepared as at 31/12/2021. That is one scenario. Another company might prepare their balance sheet as at 31st March 2022. Another company might do 30th June 2022. Another company might do as at 30th September 2022. Right? So, when you look at the financial statements of a company, there are 2 things. One is a P&L and the other is the balance sheet. P&L is prepared for a financial year, which is covering a period of 12 months. But the balance sheet will be covering the same financial year, but the position is given as of the last day of this financial year. So basically it will be 31st December 21, 31st March 22, or 30th June 22, or 30th September 2022. Okay, so that you have to remember. So what are the significance? It helps in predicting the future prospects of the business. It helps in calculating tax on business income calculated for a particular time period. So I told you why it is important, because you need to pay taxes. For the revenue or the profit you generate, you have to pay taxes. So in order to pay taxes, you need to know what is your accounting period is. It also helps the business firms to distribute their income at regular intervals as dividends. Please underline at regular intervals as dividends. Now this is something we already learned. We know the shareholders are the owners of the company. And why do they invest? Because they want a return. Now, when they want a return, you cannot be giving them return all the time. That is not possible. If a company tries to give a return on every month, or maybe say every week, that is not practical. So first thing that you have to do is you have to prepare your P&L. Now you know the P&L is prepared for an accounting period, which is 12 months. Based on that 12-month period only, I will pay a dividend to my owners or the shareholders. That is a must that you have to remember. So a dividend is paid based on the financial profitability or financial profitability status of the company, which is covering a financial year. So in other words, what does companies will do? They will pay a dividend only after the financial year is over. Okay, so every year you might pay a dividend, but that is after you complete your financial statements for that particular financial year. Because without knowing your profit, how can you decide on your dividends? You can't do that. So first you have to finalize your profit, and then only you decide how much should I pay as dividend to the shareholder. Okay, right. Any questions? Right. So now we get on to the accrual concept, the most important concept in accounting. Without this concept, no company can prepare their financial statement. This is the most fundamental accounting standard that you require to recognize your income and the expenses. Right? Look at the definition. Accrual is something that becomes due, especially an amount of money that is yet to be paid or received at the end of the accounting period. So here we are not talking about receiving cash or paying cash. I think I explained it already. We are talking about preparing financial statements in respect of your income and expenses, irrespective of whether you have received or paid in cash. Whether you have received or paid in cash. Right? So let me explain that on the board so that you will understand better. Right. The accrual. So what do we say here? What do we say here? It's twofold. One is your income. The other is your expense. Right? Here, not received, not paid. Right? So, we are talking about an entity's income or revenue or expenditure. Now, generally, you know the income when it is received in cash, you know the income is received. Similarly, when an expense is paid in cash, now if I go and pay my mobile bill, right? I go and pay my mobile bill. So what happens? I need to give out cash. I will give out cash and pay my mobile bill or electricity bill. But you can't be preparing financial statements on the basis of not paying cash. Okay? So, sorry. On the basis of purely payment of cash or receipt of cash. Now, this is what we are trying to address using the accrual concept. Irrespective of whether you received cash or paid cash, you have to account for your income and expenses. Okay, that is what we are trying to establish here. Let's look at an example. Let's say you are supposed to receive a rent income, right? A monthly rent of rupees 50,000. Is it clear to you all on the board?
Yes.
Right. Similarly, we'll say you have to pay your electricity bill. Right? And let's say we are in July now. So we'll say your June bill. Let's take. And I'm just taking an example, right? So here your rent income, where monthly rent is 50,000. The expense, your electricity bill, last you have paid for June, which is 20,000. Two scenarios. Now here what is happening is, let's say you are preparing the financial statement for July. Okay. Let me put it to December, it will be easy then. Otherwise we will get confused. I'll put this for November, right? So we are preparing financial statements for the year ended 31st December, right? We are in, let's say, assume we are in December 2021, right? So when you go to 2021 December, just assume that you have not received the income of rent for the month of December. Okay, for the remaining 11 months you have received. January to November, every month the rent income of 50,000 has been received in cash, no problem. But not received for December, not received for December, right? Similarly here, when the December month, you have not yet received your December bill. You have not yet received your December bill. But you know, for last up to November, you have paid rupees 20,000. Right? Two scenarios. One is your income and the other is your expense. Now, what does this accrual concept say? That is where the importance is. Now, if you are preparing financial statements for the year ended 31st December of 2021, you should have accounted for all the income that is receivable and all the expenses that are payable. I am repeating it again. If you are preparing financial statements for the year ended 31st December 2021, and if you are the accountant, it is your responsibility to see that you have to account for all the income that is receivable. Because received is already accounted. You don't have a problem. Right? Similarly, for all the expenses which are payable, if you have already paid, there is no problem again because cash is already paid. So the problem comes where the income is not yet received and the expense which is not yet paid. So you need to apply the accrual concept. What am I supposed to do? Here, I know under the rental income for December, I have not received. So I need to make a double entry. Now this is where the double entry principles have to be very strong. You need to know how should I raise the double entry. So here under the accrual concept, I am supposed to make a provision. We call it as a provision. Please remember, under the accrual concept, what you do, you make provisions. So you can make provisions for income. We call it as income provisions. You can also make provisions for expense. We call it as a expense provision. But what is the condition? Income is not yet received in cash. Expense is not yet paid in cash. So that is why I am making a provision under the accrual concept to make my financial statements more accurate. So what do I do? I need to make a double entry. So I need to debit an account and credit an account. Okay, that is how we do the double entry. So debit is something where I told you that you receive or receivable, isn't it? Because debit is mostly your asset. Debit is mostly your asset. So here we say rent receivable. And you will credit rent income account. Okay, I'm not going into the fully fledged journal because journal is coming later. We will, once we learn that, we will look at it. Right now, this is the double entry that we are talking about. You will debit an account called rent receivable for 50,000. And you will credit an account called rent income, because even though this is not yet received, I have to take it as an income, which will be received subsequently, no problem. But in order to complete my financial year, I need to make this income provision. Okay. Similarly, for the expense, now this is an expense. So I need to recognize the expense. I can't just leave it for later. So you know, expenditure by nature, what is the type? Debit or credit? Expenses, we spoke about natural balance or the normal balance.
Debit balance.
Debit balance. So you need to debit an account, expense account. So electricity, expense account. Right? And you will have to credit. Now this is not yet paid, but payable. So you can say electricity payable account. So when you say payable account, what does it mean? It's a, what is the type?
Liability.
Liability. Very good. So here you have an asset. This is just for your understanding. This is an asset. This is an income. Here you have an expense. And here you have a liability. Okay? You can take down. Or you can take a photograph also. But see that you are taking it down in into your note. Because later on when you are revising, it will be very important. Okay. Any questions? If you want any clarifications? Not, I'll go to the slide. Okay. So that is about accrual concept. What is the significance? It helps in knowing actual expenses and actual income during a particular time period. So as I told you, you will have the details of all income and expenses without any delay, because you have considered all the income and expenses of the company. So there is no delay or that you have left out. Of your income and expenses. Then it helps in calculating the net profit of the business. Of course, this is not very much significant, but in order to calculate your profit or loss accurately, you will need this income accrual concept to recognize all your income and expenses. Right. Adding to the same concept that is on the accrual concept, we have something called matching concept. Matching concept talks about where you need to match your income and expenses for the financial year, right? Now say you are running a business, and when you are running this business, you incur so much of expenses. So why you incur those expenses? That is to generate your income. That is to generate your revenue or income or sales, whatever you may call. So what does this matching concept says is, it states that the revenue and the expenses incurred to earn the revenues must belong to the same accounting period. Okay, so what does it say? It states that the revenue and the expenses you incur to earn that revenue, right, must belong to the same accounting period. Now say for example, you all of you or most of you all must be working in banks. So you make or you generate income by working there, right? So all of you are paid salaries. So what do we do? Can we say that if you are not paid salaries for this particular period, can you say that you can't work? No. Now, when it comes to accounting, the company has to say that, yes, during this period, you have to recognize certain amount of expense under the accrual concept, because on the other side, you are generating income, right? So the income that you are recognizing in your financial statement should be in line with the expenses that you incur to generate that income. Okay. How does this works in companies is, now for banks and all, it is like we are doing a financial services. So it is very difficult for us to quantify. But when you look at a normal trading company, the cost will be incurred first, because you have to do production. Now, when you are doing the production, you have to go in line with the production and look at your revenue. If there is a deferred cost or expense, you should not recognize the revenue also for that particular financial year. Okay. So your income should be recognized during the financial year for whatever the expenses that you have incurred. Okay. So let me explain you something like this. Now you paid a rent, right, for 2 years. For 2 years in advance you have paid. But when you are preparing financial statements, you need to consider only one financial year. Whatever the rent expense applicable to the current financial year, because your income that you are going to generate is also only for the current financial year. So your expenses cannot be for 2 years, whereas your income is only for one particular year. Okay, that is what this matching concept says. You have to match your expenses, you have to match your income against your expenses, and that is for the financial year. That is for the financial year. So it guides how the expenses should be matched with the revenue for determining the exact profit, right? Otherwise, what will happen? You have the expenses in one particular financial year, but the income is going to come in the next financial year. Or you would have incurred, you had to generate the income, but the expenses will come in the next financial year. So you can't have that type of mismatches in your profitability. The next one is very straightforward. Since we have already looked at the accounting period concept, this periodicity is somewhat similar to that. So what do you mean by periodicity? It says the organization can report its financial results within certain designated time periods or artificial time periods. This typically means that an entity consistently reports the results on a monthly, quarterly, or annual basis. So under the accounting period concept, we learned what is a financial year is. Now this financial year can be broken down into several pieces. That is what periodicity concept means. So let us try to understand this. Right, periodicity concept. Now here we know that under the accounting period concept, we spoke about a 12-month period for financial year. So which means starting from 0, you reach up to 12 months. Okay. 6, 1, 2, 3. Right. So you have the 12 months period, which you call it as the financial year. So you know your financial reporting happens here. But what does the periodicity concept says? Now a company cannot wait for 12 months to look at what is its profitability is, because that is too long. and you can't make any adjustments for your financial performance. Like say now, somewhere here the company is really struggling. But if you want to turn around the company, then you have to make some adjustments during the remaining period to make it a good performance for the financial year. So what does the companies do is they monitor performance at a different interval. The company can decide on that depending on their requirement. This is what periodicity concept is. So a company can decide, no, I will do my financial reporting annually. That is not a problem. This is annually, right? When you cover this entire period, that is annual. That is annual. But the company can decide, no, I am going to do monthly reporting. Monthly reporting. January, February, March, like this. So that is known as monthly reporting. So company will prepare financial statements every month for the management to understand where they stand. So what have they done? They have taken the financial year and they have divided into 12 small pieces. 12 small pieces for reporting purposes. So on a monthly basis, they will prepare your P&L, balance sheet, everything will be prepared. And that they will be sending it to their management and the board of directors for them to look at those and make corrective decisions for the remaining period. Because if you wait till the December, it will be too late. You can't make any adjustments. So it is very important that you do a monthly reporting. This is very common. In companies today, monthly reporting is very common. But on top of that, you can even go for weekly reporting, right? But generally, it is monthly reporting. Now, in addition to that, you can have something like this. Now, what is this? What you can call it?
Quarter.
Quarterly reporting. Very good. This is known as quarterly reporting. So, I divide again the 12-month period into 3 months buckets. 3 months buckets. So, I call this as Q1, quarter 1. This is as Q2. This is quarter 3. This is quarter 4. Do you understand that? This is another way of producing your financial results. So, I wait for 3 months. And I do my financial reporting here. I wait for another 3 months, I do it here. Another 3 months, wait here. Another 3 months. So what happens? I am splitting the 12 months performance into 4 buckets. So here also, the management will get to know at least once in 3 months what the company is performing. Now in today's context, you know, all the listed companies in Sri Lanka, listed companies, that is the companies which are listed in the Colombo Stock Exchange, supposed to prepare and publish their financial statements quarterly. We call that interim financial statements. Interim financial statements. So you need to prepare your interim financial statements and publish it in the newspapers for the banks, and you have to give it to the Colombo Stock Exchange. That's a must. That's a compulsory thing that you have to do. This is a very compulsory. All listed companies should send their financial statements, interim financial statements on this quarter. So you may be wondering how you can send it to the stock exchange. Now I end the first quarter. When should I send it? Any idea? When you finish your first quarter, when should I send it to the stock exchange? My first quarter financial statements. Any idea? It has to be 45 days, within 45 days from here. Within 45 days from here. So you know altogether it is 90 days here. Within 45 days here. So within 45 days from here. Within 45 days from here. Within last one actually they give 60 days. That is how it is done. Right? So that we will learn later on when we look at regulations and compliances under business accounting. So right now what you have to remember is this. So what does the periodicity concept says? The company can have its own way of financial reporting. It could be the financial year can be divided into artificial time periods. It could be monthly, it could be quarterly, or it could be biannually, or it could be weekly, or it could be fortnight, anything which is convenient to the company. It's their own decision. But accounting period concept says that your income and expenses should be recognized for a period of 12 months. Okay, quickly take down. Okay. Right. We'll go back to the presentation. So this is what I have been, sorry. Right? So the accounting period can be divided into 12 months periods, quarterly 3 month periods, or maybe you can have an annual period. Okay, right. Then the next concept is where we call it as the accounting cost concept. Accounting cost concept. So the accounting cost concept says that all assets are recorded in the books of accounts at their purchase price, which includes cost of acquisition, transportation, and installation, and not at its market price. So let me give you an example. Now, in my first lesson, the last part that we completed, or the second chapter where we concluded saying there are measurement methods of costs, where we looked at historical cost, current cost, net realizable value, and the present value. Now, this is something related to those. What do you mean by accounting cost concept? Accounting cost concept means where when you are recognizing your income and the assets in your books, how will you recognize the value? So when you are recognizing the value, what you need to consider is their purchase price, which includes the cost of the acquisition, transportation, and installation. Those types have to be considered, not the market price. So what do you mean by this? Okay, now let's see what this is. Right. Now let's assume you are a apparel company, or let's say you are a manufacturer. Manufacturer of, like, let's say some material, or maybe say garments, manufacturer of garments. So this is your company. Now, to your company, you decide to bring in a new machinery. You want to bring in a new machinery. That is a new machine. So your existing machines are all now giving problems. So you want to bring a new machine to your factory to continue with the production of garments. So what do? You know that this machine is not locally available. In Sri Lanka, it is not available. By the way, we assume that your factory is at, let's say, a remote area. Will take some faraway place. Right. I'm just taking an example. Right. You are located in Amilipitia. Okay. So which is far from Colombo. Let's say your factory is located in Amilipitia. Right. Now you want to bring down a machine which is not available locally, and you have a foreign vendor. Right. There is a German company which is specialized in these type of machines. So you want to get down the machine from them. So you have discussed with them and you agree a price for this high value machine. Let's say the machine is worth, let's say, 25 million, right? We call that as the cost. So cost of the machine is 25 million. So when you get the machine, you have to pay them 25 million. That is how you have to can you all see the board? idea up to now, like you are a manufacturer of garments, you want a new machine, and you have spoken to a vendor in Germany, and they have agreed to give you the machine at 25 million. Right? So you will go to the bank and do all the arrangements. Right. Now this supplier has agreed to send this machine. So how do they get the machine? They will put it to the what? You can't bring it down in a vehicle, no? So it has to be through the vessel. It has to be through the vessel. You have to bring it down from ship. Now this 25 million worth machine is going to come through the vessel to Sri Lanka. Right? Can you just get it down here without anything? What do you need to do? Probably there will be a transportation cost. Now you have to send it from Germany, you have to send it to Sri Lanka. No? So there will be a transportation cost. Let's assume that transportation cost is borne by this company. So I don't have a problem. I don't have to pay. It is his problem. But the safety of this machine is very important for me. I need to get this safely to Sri Lanka. So what do I need to do? What do I need to do? Yes?
Insurance.
I need to do an insurance for this machine. Otherwise, by the time it comes here, it is a damaged machine. What do I do? After all paying 25 million for this, am I to get down a machine which is not working? So I need to insure this machine. So my insurance, I need to pay, right? But I need to pay only I am taking here, right? I am just taking that the insurance is paid my bill, right? I will pay an insurance of, let's say, 2 million. I'm talking all in Sri Lankan rupees, huh? Sri Lankan rupee equivalent. So I am paying insurance worth of 2 million. Right. Now this vessel has reached Sri Lanka. Now it is in the Colombo port. Colombo port. Right. Now what will happen? From the Colombo port, where should it go? It needs to go to Ambilipitia. Right. Now, so how do I take it to there? Can I take it in a bus or in my private vehicle? Can I do that? How do I take it there? I need a container. I need a container to transport this. So that is local, no? I have to get somebody to transport this machine, right? So now I have a transportation. Right? I have a transportation cost. Let's say again for the transportation I'm taking 0.5 million, right? Just an example, don't worry about it, the numbers, just for example, and make it very simple. Now when it came through the ship or the vessel, you made an insurance. Now from here to here, what do you think? From here to here, should it again take insurance? Yes, generally, until the machine reaches your factory, you have to safeguard the asset. So you have to pay insurance. So let's say here the insurance is 1.5 million. I'm just taking examples, don't worry too much. Or let's say 1 million, without making it too much. Now the machine has come here. It has reached Ambilipitia, no problem. Machine is in good condition. Can you just switch on the machine and start working it? Can you do that? Can you start working from the machine, just switching on? Can you do it? No,
No.
you can't do that because you are not an expert in this machine, using this machine. You need to have expertise. So what normally happens is, if there are people here who are experts, you will get them down for you to do the installation. Now, even a normal computer, a laptop, you can't just use it off the shelf. You need to install your softwares, you need to do a virus guard, so many things are there. So there is setup and installation is required. Likewise, for this machine also, there is some installation required, right? So let's say you get down experts to do it, another 0.5 million. Because this is a high value machine. That machine is going to generate a lot of revenue for you. So I have paid that also. By the time all these happens, let's say this machine which was here is roughly now 27 million. This is, we call it as the market value. Right? It's not a long time period, but that is the accepted market value. Now, what is the question that we are trying to establish here? Now, when it reaches here, this garment manufacturer, now he has to pay for all these. So you have to pay cash or whatever for all these. Now the question is, what is the value of this asset? What is the value of this machine in the books? That is the question. What is the value that I will show in my book or in my accounts as the value of the machine? That is the question. Can somebody tell me what is the value?
29 million.
29 million. That is one answer. Are there any other answers? One answer I have got 29 million. So how come that is 25?
28.5 million.
28.5. 25. You are saying 28.5, right? Okay. Are there any other answers? Another person says 27 million. Right. Now, okay, 29 million again. So can somebody tell me how come you took 29 million? Can you explain? For the benefit of others.
The price purchase 25 million plus the insurance plus the installation charges and transportation.
27, then it has to be 27.5 no? Or you are taking everything?
Everything that 2 million insurance which we paid for
Plus
the time of plus that 0.5 million installation,
right,
and again 1 million insurance in transportation
right.
plus
So
it's
what
5.5 insurance.
transportation?
Yes.
Yeah. So like why did you decide like that? What made you to think like that?
Because that all the cost had to bear by the buyer, no?
All costs were incurred by the buyer. Right. Okay. But I didn't spend that much for the machine. No? Machine, I purchased it only for 25 million. So all the other expenses are to see that the machine comes to my factory at Ambilipitia and it's set up and working. The value that I paid is only 25 million. All the others are like, say, to see that the machine is coming in good shape and that to ensure that. Another person said 28.5. Can I know the reason? $28.5. What is that you left out, or how did you arrive at it? Any idea? So another person said 27. How did you get 27? We have more answers. 29.5, 31. Oh my God. We will have more and more answers coming in. Okay, let me put a full stop there. Right. So here, this is where we need to understand that the concept or the assumptions or the accounting concepts that we make use, right? That is where this accounting cost concept comes into the picture. Now, what does it say? According to the accounting concept, what you have to recognize as the cost of the asset is the purchase price, any installation cost, and blah, blah, blah. Right? So it is not very clear. It's just a guideline only. But we need to understand the principles. What does it say? You will again learn it when you are doing the LKS 1.6, we will do it. But let us try to establish the principle here. Now, when you are purchasing an asset, right? You might purchase it from the shop, or you might purchase it like this from another country, wherever you might purchase it. I don't mind. But from the point of the purchase, to make it available at your location where it can be used, you make it into usable condition. You make it into a usable condition. Until such time, all my expenses that I incur is the value of the machine. Okay? Do you understand that concept? That is what accounting cost concept says. From the point of view of my purchase to the point I make it where the asset is ready to use. Now it is ready to use. Once you do the installation only, it is ready to use. So until I make it ready to use, all the expenses I have incurred will add up to the value of the machine. So it is not 25 million that I paid to this machine. In between, I had to incur an insurance. After bringing it into the Colombo port, I have to transport it. For that transportation, I have to insure it. Then after getting it into the factory, still I can't use it because it needs some installation. So once I complete this only, the machine is in a usable condition, ready to use. We call it as ready to use. So if it is ready to use, until such time, all the expenses that you have incurred should be part of the value of the machine. So in other words, it will be 29 million. So the gentleman who explained how he arrived at 29 million is exactly correct. That should be the value. This 27 million is just an indication. Just an indication. Now, in today's context, this 29 million is actually, now we call it as the fair value. Right? Under the new concepts, accounting principles, we call it as the fair value of the machine. That is the fair value of the machine. Okay? Is that understood? Right, please take down. Okay. Right. So let's get back to the presentation.
Excuse me, sir. There's a
Yeah.
question.
Yes.
Let's say if the buyer had to bear the cost of the test run, then can he adapt that particular amount to this purchasing
No,
price?
generally we don't add those those goes as pre-production costs. Okay, pre-production costs generally we don't capitalize it. That is like, say, whether you need to test this machine, whether it is producing the particular garment in the right way. That is what you are referring, right?
Yes, sir.
So those type of pre-production costs, normally we have to bear it as a P&L cost. We normally don't attribute it to the machine, because machine is, from the point it is installed, it is ready to use. But whatever, whether it is the product is failing or not, that's a different story. That we attribute as a pre-production cost. Now, if you are doing the management accounting, then this is covered actually. For us, it is not part of our syllabus. But that's a valid question, very valid question. This is the phase where you are trying to see whether this machine is producing the product in the right manner, right? So that is, you will do some fine tuning to ensure that it is producing in the right manner. But that goes as part of pre-production costs. Pre-production costs. Okay, am I clear?
Yes, clear. Thank you, sir.
Okay, right. Any other questions? Good. In between, you have to ask some questions. Otherwise, all of us will get bored, no? So you have to ask questions. Yes. Right. Accounting cost concept. Then the significance. This concept requires asset to be shown at the price it has been acquired, which can be varied from the supporting documents. It helps in calculating depreciation. Yes, the effect of cost concept is that if the business entity does not pay anything for an asset, this item will not be shown in the books of accounts. Do you understand that? Now, if you have not paid for anything, then it will be like a gift. Okay? Why you show it as a cost to you? Because you have paid for it. If you have not paid, then it will be like a gift to you. Right, materiality concept. The materiality concept states that the financial information is material to the financial statements if it would change the opinion or view of a reasonable person. Now, the definition of a reasonable person is somebody who can understand the financial statements of a company, right? That is what this reasonable person means. Someone who is knowledgeable and who can understand the financial statements, interpret and understand the financial statements. So that kind of a person, if they are to make a decision, if they are to make a decision, if you are not providing something which is not, which is very much material, and if it is going to change the decision of a person, then that particular piece of information should be provided, right? So the materiality concept is very much important when you are preparing financial statements to establish whether you need to provide additional information or not, or whether you should recognize it or not. There are so many things. So let me give you an example, right? Now let's say you do a floor polishing at your home, sorry, or maybe in your office premises. Now this floor polishing costs you around 200,000. Let's say it costs you around 200,000, right? Similarly, you have to do a major repair at your office to one of your assets or maybe some equipment. That costs you around 100,000. Okay, please try to understand. You are doing a major repair to one of your machines which is costing 100,000, and you are doing a floor polishing which is costing 200,000, right? Now, from the point of view of an accountant, if you ask which one is more material, what would you say? Which one would be more material to the business? Anyone? Definitely, polishing the floor is not material, because even without polishing the floor, you can run the business. There is no harm. Okay? But repairing the machine or the equipment is a must, because the business will definitely depend on that machine. So as a result, you need to have that in place. That is in terms of the situation of the event. Now sometimes this materiality can change depending on the amounts also. Depending on the amounts also. Like a transaction with a higher value may not be material, but a transaction which is with a smaller amount may be material. Let me give you an example. You do a stock verification, right? You do a stock verification of your stocks. Around 50,000 worth of stocks are missing. Around 50,000 worth of stocks are missing, right? Similarly, you do a calculation, let's say for depreciation for the time being, and there is an error of 100,000 in the depreciation calculation. Which one is material? Which one is material? What do you think? Of course, here the 50,000 in terms of the stock valuation is very, very important, because stock is very important to a business. If there is a loss in value, then it is a biggest loss to the business. But depreciation, doing the calculation erroneously, is not material, because depreciation is just a book entry. Later on you will learn depreciation is just a book entry. Even if you don't do it, there is no problem. But an error in the stock valuation will have a greater impact to the financial statements. Okay, so materiality is another important concept. So the concept is relative in size and importance. I gave you two examples. Both, one explains the size and the importance. Most of the time, financial information materiality is judged on qualitative and quantitative characteristics. Okay, so the first one I gave you is somewhat to do with a qualitative characteristic. Second one is something to do with the quantitative characteristic. Then we also have a concept called prudence, which is also widely used and important. The rationale behind prudence is that the company should not recognize an asset at a value that is higher than the amount which is expected to be recovered from its sale or use. So I may relate this to the same example of machinery that we used for the accounting cost concept. Now, under this particular concept, if somebody goes and recognizes a value of, let's say somebody gave me 31 million also, right? So ultimately we understood that it is 29 million. But if somebody goes and estimates it to be 31 million, this concept of prudence says it is wrong, right? The prudence concept says it is wrong. Why? A company should not recognize an asset at a value that is higher than the amount which is expected to be recovered. So here we expect to recover 29 million. But if you go and record it at 31 million, then there's a problem. Similarly, liabilities of an entity should not be presented below the amount that it is likely to be paid. Now say your electricity bill is payable is 20,000, but you make a provision only for 10,000, which is wrong. Why? If you are understating your liability, means that is again you are putting your company into trouble. Okay, you should not never ever understate your liabilities. Similarly, you should not overstate your assets. Okay, that is the two key points. The first point says, do not overstate your assets. Please take down if you are having the handout. The first point says, do not overstate your assets. Second point says, do not understate your liabilities. Do not understate your liabilities, because both are not good for the business. Both are not good for the business. Right? What is the significance? There is an inherent risk that assets and income of an entity are more likely to be overstated than understated by the management. Okay, so there is a tendency where people will like to show a higher asset value and similarly a higher income value, whereas liabilities and expenses, they want to understate it. They like to do it, but it is not permitted. It is not permitted. Timeliness concept. This refers to the need for accounting information to be presented to the users in time to fulfill their decision-making needs. So if you are a company who is preparing financial statements annually, let's say the last financial year is December 2020. Now, if you have not yet produced your financial results, no point in preparing it anymore, because it has already lapsed the time period. So what does the timeliness concept says is, you need to prepare your financial information and provide it on a timely manner to the decision makers. On a timely manner to the decision makers. So timeliness of accounting information is highly desirable, since information that is presented timely is generally more relevant to the users for their decision making. So full disclosure, of course, you will not understand right now at this point in time. The meaning of disclosure is the information that you provide to the reader. Any additional information that you provide to the reader is called disclosure. So if you are a company making such information, detailed information, you need to provide in full. You can't just quantify certain disclosure and provide them. No, that is not permitted. The accounting standards require you to provide disclosures in full. Okay, so we will learn this maybe towards the latter part of our course, where we need to provide certain disclosures for the reader. Even in your examination, you might be tested on these disclosures. Okay, so that we will learn later on. And the significance, as I told you, it is more important for the reader to know all details relating to your financial performance. Right. So that brings us to the end of accounting concepts. So now it is very important that you go through all these information when you are you have to revise all the work that has been given, and up to now we have done with 4 chapters. So we started with the introduction, then we went on to look at the framework for accounting, and then we looked at the accounting process, where we started looking at the double entry principle, and we also looked at the accounting equation, and now we have done with the accounting concepts, right? So basically what would I say is, these are the basic things that we have learned so far. Now we are getting into the little more trickier areas, right? Now it is all done. I have given the foundation required for us to go to the next level. Okay, so during this course, how I have structured it is, like for the first 6 subjects or chapters that we do, it will form the foundation. The next maybe 6 to 7 topics will be getting us into the more detailed ones. The final 6 to 7 topics will be the more complex ones. Okay, so I don't want to make you frightened right now itself, but the more complex one will be coming at the last. The last 5 or 6 chapters will be the most complex one. So now, if you are to travel along with me, you need to be thorough with what we have learned so far. Okay, because from next coming Saturday, we will start on with the next topic. I think the handouts are already shared. So first you have to revise what we have already done. Okay, because as we go on, I will make use of these terminologies. And at that point, you shouldn't be thinking about what this is. I might talk about double entries. I might talk about accrual concept, accounting periods. I will make use of all these terms as we go on. So you shouldn't be thinking about at that time what all this is. So please ensure that you revise on a timely manner, and also ensure that you know these terms. What does it mean and their applicability? Okay, right. So we have almost come to the closure. So let's meet up on Saturday with the new topic. I expect you all to complete your revision work by that time. Okay, take care and bye.